Hello, everyone. We're just having people come in, so we'll give it a few more minutes, but we're almost at 100 participants, which is great. So we'll just give it a few more seconds and then we'll get going. Right, we've hit the crucial 100 mark, so I'll kick things off. Hello and welcome, everyone. My name is Martin Turner. I'm really pleased to welcome you to this Spring Budget webinar. What does it mean for life sciences? Where we have an expert panel in front of you. Got myself, Head of Policy and Public Affairs at the BIA. I'll be chairing today's webinar. Steve Bates, CEO from the BIA. Colin Haley, partner at Confluence Tax and chair of the BIA's Finance and Tax Committee. Mel Strange, chief financial officer at Brainomics and vice chair of the Finance and Tax Committee at the BIA. And then finally, Richard Turner, senior managing director at FTI Consulting and member of the Finance and Tax Committee. And in front of you, you've really got the Navy SEALs of the R&D tax credits policy world. And we're really pleased to be able to talk to you today about the work that we've been doing on the spring budget, all the other announcements that were in the spring budget, and what they mean for the life sciences sector. There's a Q&A function in this webinar, so please do pop those in as we go along. We'll answer them at the end. There's a chat function as well, which you're welcome to chat on, but please do try and keep questions in the Q&A box where I'll be able to find them nice and easy. So, moving on, it's been a very busy week for biotech, to say the least. And we will get on to speaking about the spring budget. But first, we wanted to look back a long time ago at the weekend just gone, where there was just a little bit of difficulty in the sector and the wider tech world, with Silicon Valley Bank essentially collapsing over the weekend. Hopefully you guys know that BIA was right at the heart of this, trying to help the Treasury and Bank of England understand the seriousness of this situation. And we really wanted to just touch on it now because I think it provides quite an important backdrop to the spring budget, not least because we heard the Chancellor say Silicon Valley many fewer times than he did at the autumn budget. Apparently they're striking it out at the last minute. But Steve, I mean, have you recovered from the weekend that we've just had? And do you have any reflections? I mean, how do you think it impacted this, the kind of setting the scene of the spring budget?
So Martin, I haven't recovered yet, and you can see me eating emergency bananas as we go through to try and keep me going. It does feel like it's not really stopped. So first of all, thank you to BIA members who enabled us to provide the data to rapidly at the weekend to right size the challenge and the problem. And I think what we're very pleased about is the speed at which the Treasury, the Bank of England, the government in general, up to the Chancellor and the Prime Minister engaged on this. We probably weren't as vocal in life sciences as some of the tech gang were, but we were certainly full participants in the work that went on across the weekend. And I hope it's turned out to be a pretty good result in the HSBC's taken over guaranteed depositors positions, and the bankers continue to function under new ownership this week. Probably not the time to get into the ins and outs of it now, other than to say thank you for your engagement. I hope we've got a strong outcome. We realise it could have been very, very different, and it was touch and go for much of the weekend around this. What I'm looking for really from members now is, how's it gone? I know on Monday there were still some teething problems as banking were going on, but I'm keen to get perspectives. Drop me an email or put in the chat if there's things that you want us to do. Engaging closely with HSBC, and I think there is a strategic opportunity with a large UK bank now keen to bank our sector they're particularly pleased that that they've had good customer reaction, and I know they want to build a strong relationship with us. So I know this has it still has broader ramifications that are running in the States, broader ramifications with European banks and regional banks elsewhere. But from our very narrow perspective, I hope crisis has been averted. But it did provide an interesting backdrop to the week, and of course, much of the work that we'll talk about later in terms of engaging with the Treasury ahead of the budget, help them understand our sector. And I think the speed at which they've acted shows the priority that the government puts on the life sciences sector, which is really useful for us to know.
Yeah, thanks, Steve. So yes, we're very interested to hear what members have to say about that. Hopefully you've all got mine and Steve's email addresses. Many of you know Colin and our other panelists. The Finance and Tax Committee will continue to monitor this and think about what further support and advice our members might need in light of the exposure that we all kind of discovered was so crucial. But moving on to the main event and the spring budget. Jeremy Hunt's first spring budget as Chancellor, the first budget, full fiscal event that we've had in 17 months. And of course, a pretty crucial one for the UK economy following the turbulence of last year as well. But all eyes, in our sector at least, were on the question of, would there be any updates, any movement on the SME R&D tax credit cut that was announced at the autumn statement, when the Chancellor announced that the rate of relief would be slashed down to 18p. You all know, and many of you have helped to be part of the campaign that the BIA has led in the past 4 months to effect a change in Treasury thinking and policy on this. And we were delighted when the Chancellor did indeed stand up and say that he wanted to support R&D intensive SMEs and provide an enhanced rate of 27p in the pound, 27% cash payment for loss-making SMEs. And this was really the centerpiece of the spring budget for us, and we're delighted to see it happen. Now, it was not an easy thing to make happen. And before we kind of go into the detail of what it actually means now for life science companies, how it's going to work and be able to answer your questions, I just want to take a step back 4 months ago to the autumn statement and the shock and the surprise that we felt. Steve, we were at an investment conference for the life sciences that we organised with the government that day. So to get the news that another part of government was implementing or suggesting a policy that was going to kind of run very much counter the investment that we are trying to get into the sector, working with other government departments. It was quite a shock. I mean, we had an autumn statement webinar where we kind of told some of this story, but a lot has happened since. So for our audience, Steve, let's go back to the beginning and can you take us through what happened?
Yeah, so I suppose on Saturday we were facing the collapse of the sector with 40% of our companies banked with a bank that was shut, and we were facing an R&D tax credit to 18p in the pound. So hopefully by Thursday things have got significantly better, and part of that is due to both of these, really down to the fact that you guys have been with us, enabled us to provide the data and the capacity to take the case to the government and convince the government of the benefits of and the needs and requirements of life science companies in the UK, and that's sold on the basis that we know that that companies can provide economic growth and do amazing things to face the challenge as society challenges. So we've done quite a lot of work behind the scenes. I hope we've provided both a factual basis. Obviously, before the autumn statement, we've always been involved in R&D tax credit policy, and to some extent over 20 years it's been nudges around the edges, whilst the solidity of it has been central. So what was shocking was to see something happen without any knowledge or any expectation. And I suppose last year was a weird world in Treasury statements, because they, as you say, we didn't have a proper budget, but we've had several mini budgets or fiscal events or all the rest of it. I think being able to marshal the case, being able to show that the sector would respond positively, that there was an absolute need for this to be globally competitive and for our companies to get going was important, and to crowd in investment from private sector. So much of this has been quiet work, much of this has been policy work by Martin, excellent advocacy from the Finance and Tax Advisory Committee, being able to use our networks and provide evidence. But I think we've got to an excellent place, and I hope what this has also done is it's provided us with a platform to continue to gauge on your behalf on matters of industrial strategic input to the Treasury in an ongoing format. So I hope we'll go back to the days where there are, if you like, minor tweaks or improvements to this scheme as we go forward, and that we don't see headline raising changes with very little notice, which I think was one of the major problems. But I hope you found it useful, and without this campaign we certainly would be 18p in the pound, and probably we wouldn't have had the contacts to do what we did at the weekend. Yeah.
I mean, the 300 signatures that we got for the letter that we put into the Chancellor before Christmas, I mean, we got those 300 signatures in, 3 days? Probably less than that, I think. And it showed the strength of feeling in the sector. And I think the officials got that. And after it was raised in Parliament as well by Anthony Brown, which was great. Many of our members were writing into their MPs and getting it raised as well. I think Treasury seized and understood the issue reasonably quickly. And then it was down to Colin, Richard and Mel, who joined me and yourself, Steve, in many meetings with officials. And the Finance and Tax Committee was really valuable in providing comment and expertise as well. And Colin, I mean, what was your reflection from the meetings that we had with officials during the campaign?
I think to put it politely, we had to take them on a journey through the proper analysis that I think, to be frank, they hadn't had time to do before the autumn statement. Once they'd been through it, they could see that they created a problem, and they were then very happy to engage constructively to fix it. But I think they, as Steve said, it wasn't a normal fiscal event, the autumn statement. It then created it was a short-circuited process done in the Treasury without proper analysis, and therefore what was great was the BIA already had the contacts to take them through a proper analysis. They listened to us. We are a sensible trade body. We're going to take you through this and show you where you're going wrong. And once we got that level of engagement, I think the scene was well set to get to where we got to yesterday.
Yeah, and Richard, you did a lot of the number crunching on the data that members gave us. How valuable was it to have so much input from the members?
Oh, incredibly. As you know, that when HMRC and Treasury want input, it's generally more forthcoming from advisory bodies and trade bodies. So when actually they get it firsthand from companies and get that company data, which is often very, very difficult to get, it's invaluable, and that had huge impact in getting us to where we got. And not only that, I think a really big positive from this exercise as well, I wouldn't wish it again, by the way, but a really big positive is that I think it's helped moved HMT's and HMRC's understanding of the quite nuanced business model that life sciences has, especially early stage. And there's more work to do there, but I think that's really going to lead well into the current consultation.
Yeah. And just to add on that, I think it always amazes me how much within government they need data. You assume that they've got sources of data and they just press a button and pull out, let's do an analysis of all biotech companies with headcounts below, whatever. They do not have that data. They've never ever, to my mind, had the data that they need to implement policy properly, and therefore it's absolutely invaluable being able to go to the BIA membership and say, please give us your case studies, give us your data as quickly as you can. It absolutely does inform policy, and government do not have it at their fingertips ever.
Yeah. And Mel, we're going to come on later to how the spring budget measures in totality what they mean for the sector, how they impact companies. But in terms of the work that we did over the past 4 months, you were in quite a different position to the rest of us, in that you were actually a company that would be impacted. I mean, how was it from where you were sitting to kind of be on the inside of this process throughout the past 4 months?
Yeah, I think firstly, it was a huge privilege to be part of this effort. And I have to say, obviously, a lot of the credit go to others on this call. I was very much around the edges and periphery. And for me, it was just amazing to see how this group worked together, and then how the wider BIA membership kind of came together and responded really quickly when we were trying to get some of the data out. I've got some kind of memories of, we had a number of different calls, and I still remember being on one call and joining the call going, so which bit are we talking about now? Because things were moving so quickly, and we're all doing other things in our lives. I've got my kind of full-time day job, and without kind of the work from Martin, Richard, Steve and Colin on this, we wouldn't be where we are. So I think we owe a lot to the BIA and the work they've done.
Yeah, it's been a really rewarding process to be part of, not least because everyone from the whole of the BIA membership has been pitching in and cheering us on as well. So it's been fantastic. Right, but this isn't a soppy webinar. This is a hard tax webinar. So we need to get into the policy detail, into the tax detail. So Colin, as one of our top tax experts, do you want to take us through what has been announced by the spring budget yesterday?
Well, I'll talk for a bit, and Richard can tell me where I go wrong. That's normally how it works. So I think essentially what was announced yesterday, it's a higher rate of credit, but it's sitting in the existing SME scheme. So you go through the normal process. Are we an SME? We want to make a claim. What have we got in terms of our usual staff costs, subcontract costs, consumable costs? You do all that stuff you would normally do. And I see a question in the chat about how this relates to RDEC. Same considerations. If you've got a project that's supported by grant funding, you can't put it into this rate of relief. It just sits in RDEC. So it's the normal SME scheme you're doing. And you then say, right, what rate of relief can I get? Can I get the high rate of relief? What are conditions to get inside that valuable higher rate bucket? You need to be an SME. You need to be loss making. So this is the higher rate of relief when you're making a cash credit claim. Yeah. So if you're a profitable company, sorry, but this doesn't apply to you. This is just if you're loss making. And then finally, and this is the really new bit, which we haven't had in the SME scheme before, to get the higher rate of relief, you also need to have an R&D intensity or an R&D fraction of 40% or greater. We'll come on to what that means in terms of how you measure R&D intensity, but you need all of those three things: loss-making SME with a high R&D intensity in order to get this high rate of relief. The Treasury basically picked the 40% and picked, here's how we're going to measure R&D intensity. But so that was their concept of what is an R&D intensive company. They didn't write this and say this only applies to biotech companies or only applies to life science companies, but they did it in this way. They're after a particular population. I guess they're managing, well, how much room have we got in the budget in order to make this measure work? So there will undoubtedly, when you do this kind of thing and say there are three conditions, you've got to meet all three of them, there will be losers on this who say, well, we're a good company too, why can't we be in this rate of relief? As we sit here now, the rules are going to require all these three things. And if you don't meet all of them, you won't be in the right place. You're into then the 18% rate of relief, unfortunately. That's just how the Treasury chose to cut it. They had to make some big broad brush approaches to who they're going to say is in this rate of relief or not. I think, to my mind, if you are the classic loss-making drug development biotech SME, you've got no revenues, you're either preclinical or in the clinic, chances are you'll be able to get inside this bracket. There'll be lots of other people who, for all sorts of either structural or timing reasons, don't get into it. But in terms of the real sort of standard drug development loss-making SMEs, you should be able to get into this rate of relief. I think that's where that's where it's positioned in my head at the moment. But probably time to say next slide, please. Richard, do you want to talk us through a bit more of the nuances on this?
Yes, and then maybe to answer, I've seen a couple of questions that have popped up as well. So the R&D intensity threshold will be a simple calculation based on qualifying R&D expenditure that you include in your tax computation. So on some of the subtleties, subcontract R&D, it will be 65%. So third-party R&D is included in answer to one of the questions, but you'll only be able to claim 65% of it. But you would include your SME and RDEC qualifying expenditure in terms of the top half of that fraction. And then that has to be weighed against your total expenditure across the entire economic group. So that's all companies, whether they're UK or overseas. I'll come back onto what it might or might not be included in expenditure. But at the moment, I think that the best calculation is to look at your total operating expenditure and assume that's going to be the denominator. Now, this takes effect from 1st of April. So the rate decrease takes effect from the 1st of April for expenditure on or after. And this booster also sort of counters that from the same point in time. Now, most companies won't have a March year end, some will, but so most companies will straddle that. But the way you calculate this fraction will be for your full accounting period. So I should imagine most companies will be December year ends. So expenditure from 1st of April through to the end of December will be caught by this, but you'll measure that fraction with reference to the 12-month expenditure. So there's a few things to consider. This fraction will be need to be calculated on a year-by-year basis. As you move through the clinic, you'll probably be outsourcing more, and therefore you'll be that 60% calculation on your outsourced expenditure will probably have some impact on reducing your R&D intensity. So you need to be mindful of that. There was a technical note released yesterday, and literally what we've covered so far is what's in that. Now, I think the details of the calculation, there will be further details. There will be draft legislation we're expecting in sometime in July. I'm not sure whether we'll get wind of how that calculation, the subtleties of the calculation prior to that, but there's going to be some obvious questions that are going to occur to many of us probably already. But will large one-off exceptional costs be included? They may be share-based payments, maybe one-off transaction costs, impairments as well, or those you'd see often those will be counter each other on consolidation, foreign exchange and financing. So those need to be thrashed out at that level of detail. I'm sure between now and then we'll be looking to engage with HMT, HMRC to try and get a feed. We've already fed some thoughts in around that calculation, but to try and get some more clarity around that. So really companies can have a very sort of clear playing field on sort of business as usual costs. I think that's how the fraction should work. And then, of course, and I'll come on to this as well, the restriction on overseas activities has been moved forward a year, but probably will come in, and that will have an impact as well. So, we will need to keep an eye and an understanding on how those may impact your R&D intensity.
Yeah, I mean, just the thing that struck me, and it is in the R&D technical note that was released yesterday by the Treasury. This is going to be messy because you've got a finance bill that'll become a finance act when the King signs off. You've then got to have HMRC systems and computer systems be able to cope with you claiming for the higher rate of relief. So what they're saying is you're actually going to be applying originally for the 18% rate of relief, and then you may well have to go back in again to say, I now want the top up to get me up to the 27% rate of relief. So it's going to be messy. If you're doing cash flows in a business, and you've historically gone, I know I'll submit my R&D tax credit, then I should have my money, 6 weeks later, you're going to have to sort of reconsider that and say, okay, actually, it's going to be probably, when can I submit by? There's going to be some revenue computer stuff to do because they're increasing the amount of sort of information they're going to collect from companies on standard claims anyway at 18%, and then you're going to resubmit to get the 27%. So you're just going to need to take a deep breath and go into a bit of detail on that, rather than just assuming it's business as usual like it has been in prior years. There's a bit to grind through on that.
Yeah, really love to have been able to wave a magic wand and just put everything back to how it was, but unfortunately, this messy solution is the best that could be got in the circumstances. Yeah. We've got a question that's worth answering now from Cheryl. To clarify, if we are an SME conducting clinical trials which are outsourced, would that reduce their R&D intensity? So my understanding is that would, in the sense that you're only getting 65% of that outsourced cost counting towards your R&D intensity calculation. Is that correct, Colin?
Yeah, but it's still, it's still R&D expenditure. The fact you've outsourced it, it's just subcontract cost. 65% of it goes in onto the top of your fraction and helps push you over the 40% limit. So I think in that sense, it's all good. The fact it's outsourced is neither here nor there, other than it's only 65% of it. Whereas on your internal R&D cost and your own R&D staff cost, it's 100% of that goes into the top of the fraction.
Yeah, and I think the point I was trying to make earlier is that, you may be, I think typically as you progress through the R&D cycle, you have more internal costs and less external, and that weighting changes over time. So if you start off with a high R&D intensity, as you outsource more, that may become low. So you need to monitor that as you progress through the clinic. Yeah. But all R&D is good R&D.
Yeah, and I think the other point on this is don't think you can play games with this, or we can set up a subsidiary in Jersey and shovel our non-R&D spend in there, because they've thought of that. Yeah, the rules will pick up everything going on in your group and say, right, we're going to drag everything in here and say, right, where do we get to on 40%? There's going to be anti-avoidance in here for people playing games with expenditure either side of the 1st of April cutoff. So there's existing anti-avoidance in the R&D rules. Never really see the revenue use it in anger, certainly not with my client base. But I think they're bothering to mention it here, and they will be very alive to people trying to play games to get into the 27% rate of relief when they really shouldn't.
Yeah. So the 27% rate was not the only pleasant surprise in the spring budget. We have also been working for more than the past 4 months on the Treasury's move to restrict R&D expenditure that's occurred overseas. They're trying to limit companies' ability to claim on this. That was announced over a year ago, and we have been again leading the charge to secure some exemptions to that, which we have done quite successfully, where R&D has to be done overseas through necessity. But also, more recently, we have been campaigning to just have this restriction deferred for a year or more, because, to be honest, Treasury was trying to do too much too quickly. It was causing a lot of trouble for businesses. So we're really delighted to see that measure in the spring budget, that it would be deferred to the 1st of April 2024 rather than the 1st of April 2023. So that's great news. Richard, do you want to take us through what this means, what companies should be thinking, what are the outstanding questions here?
Yeah, absolutely. Thank you, Martin. So as Martin said, well, let's distinguish the fact that everything we speak about to date has been for expenditure on or after. This goes back to accounting periods beginning on or after. So again, majority of the December year ends. So this will kick in from the 1st of January 2025 for the vast majority of you. So great news that's been deferred. I've already alluded to the fact that you do still need to be mindful of it. And I'm going to see something that may surprise you. I think it's a good thing. And why am I saying that? So as you know, we're under consultation around a merged regime, and the government seem quite at the moment reasonably fixed on trying to merge the regimes. Now, that's not set in stone and may not be the case. But if there is, one of the critical things in terms of or parts of the framework needs to be the fact that there needs to be subcontract expenditure within that. And if they're going to maintain subcontract expenditure as an eligible cost, I personally can't see them doing that without keeping this in. That's why I say it's a good thing. So therefore, I think we have to accept that it's probably here to stay, and that we probably need to accept that we're going to really have to live and understand it. Who knows, but that's my view. So where are we? Draft legislation was published last year, and then there was a first draft of quite concise guidance released by HMRC beginning or just before Christmas, in fact. The majority of that initial guidance was pretty positive. It included reference to, as part of the conditions, reference to patient population, reference to lack of capacity, which you might think around particularly clinical manufacture, and also time frame, lack of the ability to execute some R&D in a particular time frame, all of which I think will lend themselves to being able to get into the bracket of qualifying overseas expenditure, so the activities undertaken overseas, which will still be eligible. Then there's some commentary around the nature and timing of, well, there's certainly commentary around the nature of evidence. This was less helpful. This was particularly with reference to regulatory reasons why you may need to undertake R&D overseas. HMRC seemed to backtrack and say that they were looking for third-party evidence, and gave an example of getting that from the regulator themselves, and we've already tried to educate them to say that how difficult or impossible that would be, and really trying to encourage them to allow companies to self-assess, as you do in so much of your tax affairs and also R&D, whether or not those conditions exist. But in some discussion with HMRC since the release of that guidance, and again, this is not set in stone, but we did clarify that companies can take a view in terms of what is qualifying overseas expenditure at the point of time that they make their tax claim or their R&D claim. Now, that may seem subtle. I think that's quite fundamental. What that's saying is companies don't necessarily need to fundamentally change the way they organize and plan their preclinical activity. They can let that happen in the same way as you do, and then you need to calculate the implications for R&D. So I think that was very helpful to get that confirmed by HMRC. Again, that's just verbally, so we'll still need to see whether that goes through. We've also been busy in trying to share some case studies that we hope may find their way into specific life sciences guidance around these rules. And we set out some examples covering trial site-based activity, central CRO costs, regulatory reasons why you may have to undertake R&D overseas, and the existence of certain levels of knowledge or skills that may exist overseas that don't exist in the UK. So hopefully those will be adopted, and that will be, I think, very helpful for companies looking to plan ahead. But the deferral, just to summarise, I think the deferral does now give companies much more time and opportunity to request better evidence from CROs and other service providers. And again, linking back to the R&D intensity point, I think that's going to be increasingly more important than we even thought it was going to be.
Yeah, I mean, hopefully what we're seeing is just a more analytical and measured approach from the Treasury, where we actually get time to input into things and get to a better place compared to what we had at the autumn statement. So it's all welcome, I think, because as we've said on this call already, you know, the industry has particular facts and circumstances that are quite different to the run-of-the-mill sort of image of UK PLC, and therefore we need to set the Treasury through that each time to make sure we get to good answers. Just wanted to pick off one question there, good question at the top of the chat, sorry, at the top of the Q&A, about someone who's got investors owning more than 50% of their company. How does the R&D intensive fraction work in terms of, you know, what cost do I bring in to work out, do I meet R&D intensity of 40% or more? You've got a fundamental question before that. If investors own more than 50% of your company, are you an SME? Yeah, if you're not an SME, then you're not getting 18% rate, never mind the 27% rate. So you got to go, the honest answer is you need to dig into detail, like a lot of things in tax, to say, am I even an SME? If I am, then do those other people involved in the company meet the connected persons test to get their expenditure dragged into yours? So there's a load of detail to go through in that. You could only get to the right answer, not on a webinar, but by getting out the structure in detail, getting details of your investor structure, and then going through it like that. It's one of those really knotty tax questions that are very interesting to tax people, but I'm afraid we can't give you a full answer here, but you do need to get resolved both in terms of SME status and then in terms of how the new fraction is going to work. And we've got press releases at the moment on how the new fraction is going to work. We do not have the law, and you're going to need to have the law answer that question properly.
Yeah, and yeah, we've got a lot of questions coming in. We do have a lot to cover, so apologies if we don't manage to answer all of them today. We'll try and do that in writing afterwards as well. But moving on, I mean, the big question is, what does this mean for members? And Mel, I mean, looking at what's been announced, what are your thoughts? What does this mean to you? What are the big unanswered questions for you?
Yeah, I think hopefully I speak for the majority of members and people on the call, is that the changes announced yesterday were really gratefully received, and I know I had a big smile when I heard it, and then even more so when I saw the bit about the overseas exemption as well. And when I think about impact, obviously two main things come to mind is, you know, how does it impact us financially? You know, does that give us more money back in the pot to spend on something else? But also, how does it impact us operationally, and how does it change how we work, what we were thinking we were going to do? And I think if I think about our member base, some of that is as important, where we've got, you know, SMEs who may not have, you know, a fully in-house finance team, but, you know, how complicated does this make their lives, or does it make it better? Obviously, it eases some of the pressure and uncertainty around the previously expected reduction in the near-term tax credit, particularly in light of the current market environment out there, and what, when we see what the rest of the year will bring us. And it's a huge win from where we were a few months ago, and it'll allow companies to focus back on R&D where they should be, and hopefully making a difference to patients. Obviously, there's some administrative things we need to think about and consider, and our calculations get a little bit more complicated, and we'll keep people like me quite busy, and then we pass that over to people like Colin and Richard to keep them busy as we try and unravel it all. But there are areas that we need to get worked through quite quickly even, so we understand, because people like to get their tax in quite promptly to get tax credits back. So we'll obviously be able to share information back out to the member base as soon as we know more, and keep everybody informed. And I think the delay in the implementation of the overseas expenditure is a really big win, and we shouldn't lose sight of that, because actually this was an area of concern. And as we had the webinar back last year about concern about, you know, how do you evidence this? How do you influence decisions about where work is done, in looking at how do you deal with prior contracted work, and what is that financial impact for us? Obviously, we've now got a bit more time to understand that and work through it and make sure we have the right processes in place, and some more information on that will be really helpful when that comes through. Wider than just tax, and obviously something Colin and Richard, I'm sure, will touch upon in a moment, is some of the other things that were announced yesterday will help us as businesses, both financially and administratively, and that should hopefully make our lives a little easier. So hopefully, off the back of yesterday, everybody's in a much happier, better place. I know I am, and I hope that's the same for you too.
Yeah, I really hope so too. Yeah, it's been a bit of a mixed response, I'd say, and obviously there's a lot in the spring budget, more than I thought there was going to be, and we're going to go through a lot of that in a minute. But also it's worth remembering, as Richard has already alluded to, that, you know, we've got this single R&D tax credit scheme coming down the line. We're kind of almost halfway through a campaign, really. This is kind of just the first battle, reasonably won. Steve, what do you think, what are you hearing from the members in terms of impact, what it means, and looking forward? Where do you think we stand with the Treasury for that next stage?
Yeah, so picking up on the point that Richard and Colin were making, which is, I think there is a better understanding now of what if the UK is focusing on being a life science superpower, as I believe we are, what is it that we actually need to get to go forward? And I think this is a good base for us to continue that discussion. I think there are lots of open questions about what we do next, and hopefully the fiscal picture will move as the economy improves, and some of the headwinds go that give subsequent budgets the chance to go further. But I think to get to this place this year at this moment is good. I'm glad to see that it looks like there's a resolution of the NHS staffing issues today. So hopefully this gives us a good platform for going for the rest of the year. And you can see that the Chancellor was already keen to talk about things in the autumn statement about unlocking pension funds and things like that. So I know their mind is there. Let's use this as a platform to go forward, and hopefully it's a much stronger base than where we were last Saturday.
Yeah, I'm pretty sure this budget wins for the number of times life sciences was mentioned. It just kept on rolling off the Chancellor's lips, so that was very good to hear. But there was an awful lot of other content, as I've said, in the spring budget. More tax, more joyful tax. So Colin or Richard, which one of you want to take us through?
I can whiz through this. Full expensing for capital allowance purposes. So capital allowances, as in the tax deductions you get for capital expenditure. So bits of kit, effectively stuff that's got a long life. Basically, historically, we've had tax depreciation at very fixed rates. So things like 18% reducing balance or complete write-off if it's R&D related. We're moving unusually on what we call plant machinery to 100% first year allowance, so complete write-off. So stuff that's kit, plant machinery, so lab equipment, desks, chairs, computers, that kind of stuff. Literally, in the year in which you spent the money, you take a tax deduction for the money you've spent. It's going to be like that. It comes in from the 1st of April 2023, runs for 3 years. Other more sort of long life assets, things that are more embedded in buildings, they'll get a 50% first year allowance. Then over time, you write off the remainder of the cost. So it does accelerate your tax deductions. If you're already loss making, well, so what? You've got losses coming out of your ears anyway. But if you are in a position of being tax paying, then you will be able to accelerate your tax deductions. So a very wide ranging measure, partly being done to make companies invest more and be able to mitigate against the fact that for large companies, corporation tax rate is going from 19% up to 25%. So if you say, well, yes, the rate's going up, but the amount of taxable profits on which I calculate that, my tax liability using that new rate will be coming down. That's the idea there. Other stuff that I don't think actually got mentioned in the Chancellor's speech, but is nonetheless very important to this community, EMI simplification. So anyone who's had the pleasure of an EMI scheme where they've, suddenly someone reviews your EMI share option scheme rules and says, you didn't point out restrictions on the shares to employees, or you haven't got the employees making declarations of their working time. And you go, well, what's that got to do with anything? We're just giving them EMI share options. Everyone knows they're the best thing you can do from a tax point of view for employee equity. You used to have to go to the revenue and say, we haven't done this in the documentation. Are my EMI share options all right? Lawyers are looking quite concerned. Those requirements are going to disappear, which is great. So a lot of that sort of very overly formal stuff the revenue got very hung up about, and therefore on due diligence people got very hung up about, is disappearing from the 6th of April 2023. Also, those of you who've ever had employees to whom you granted employee share options, EMI share options, you always had this, having granted the option within 92 days, you must tell the revenue you've granted those options. That's going into a much more normal and relaxed notification procedure. So from April 24, once you've granted the option, you can wait till you get to the end of the tax year. Then you have to do something called an employment-related securities return. And at the same time, you're able to notify the revenue, oh, by the way, in the last tax year, we granted the following EMI share options. So just very welcome normal relaxations for stuff that was overly fussy in the EMI rules. And finally, something which is, again, very welcome, there are things called CSOP schemes, so company share ownership plan schemes, always intended to be EMIs for small companies, CSOPs are share option plans for bigger companies that don't meet the EMI rules. But again, there were these funny nuances in the CSOP rules about certain kinds of shares could only be used to be putting under CSOP option. And quite often, ordinary shares just didn't meet the tests to be eligible for CSOP schemes. They're basically going to delete the piece of the rules that made it really hard work. So what I think we'll get to is you do EMI, and when you hit the buffers on EMI because your company's too big, like you've got gross assets of more than £30 million, you'll now be able to use the CSOP scheme and grant CSOP options over your ordinary shares. So it's all good. It's very welcome. Again, we haven't seen the detail yet, but suddenly CSOP schemes could become a proper successor to an EMI share option scheme, rather than being something you either introduce but say we may never use it, we've drawn up the scheme documents but never used, or you just rule it out because you say, look, we just can't meet those tests, it's not worth it, we need to look at doing something else. So that's all good from my point of view.
Good. Thank you. And now moving away from tax measures onto other announcements. Again, there was a lot of mentions of life sciences, a lot of good words said about pharmaceuticals, and the MHRA got a 10 million budget boost along with other measures. So Steve, what are your, do you want to run through these and what are your reflections on what they mean?
So in a sense, a bit surprising that Chancellor mentions medicines regulation in a budget, but good from our sectoral perspective. I think that this is about a recognition of the importance of having a functioning regulator. We know that people have been struggling with some of the delays that the regulator has had. So I think this marks both money to help them support getting the right size organisation to be able to deliver and focus that work on particular areas, as do other regulators. And then I think, you know, the political announcement that exploring partnerships with trusted agencies to provide simple, rapid approvals of medicines and technologies from 24 also is a new direction. So if we can get things that are approved in other globally trusted regulators, then that may well also be very useful. So I think it underlines the commitment to the sector and shows recognition of an immediate problem. And I think money will be the start of that for the MHRA, and the MHRA have put out some of their own documentation on this. It's part of this broader review by Patrick Vallance about innovative regulation in a post-Brexit era. So it's probably the lifting of the veil on that, and some more things that will come probably in other sectors of science, but the MHRA getting some support here.
Yeah, Patrick Vallance's review into the regulation of AI was published alongside the spring budget, but anything to do with life sciences, even if it's involving AI, is held back for the life sciences element of his regulatory review, and they've only published the interim findings of that, but you can find more details about that on the BIA blog, and we'll be looking out for the full Vallance review of life sciences regulation in due course, and the BIA continues to engage with that work as well. Now, moving on to another welcome part of the spring budget, there was further announcements in terms of unlocking pension funds to increase investment into innovative sectors of the economy, such as life sciences. Again, this is a core policy issue for the BIA, something we've been working on for a long time, since at least 2017, if not long time before. But 2017 brought in the patient capital review, which has led us to this point, and that created the British Patient Capital, government-backed VC investor, and that has now had its remit and budget extended to 2033, which is great. It will continue to focus down increasingly on R&D intensive industries, again, really helpful. And we understand that the government has in principle said that it's going to allow British Patient Capital to essentially recycle its profits back into its investment activities as well, which is really great. So it's going to become an increasingly more independent and hopefully muscular investor, working to increase the general health of the UK venture capital environment. Also, something that was announced at the infamous mini budget of Kwasi Kwarteng. So the long-term investment in technology and science. This was a initiative handed by the then Chancellor Kwasi Kwarteng to the British Business Bank with 500 million to unlock, to develop a scheme that would unlock pension fund investment into venture capital. That has now gone through the British Business Bank. I understand there's been a lot of consultation with the pension industry, and we now have a consultation coming out, a formal consultation coming out of the Treasury, saying that there will be 250 million, so not that 500 million, but 250 million made available as leverage to get pension funds investing into venture capital. And it sets out different ways in which that could be done, and it's inviting comments on that. So that's positive progress to see. We'll be engaging in that as BIA. Elsewhere, the spring budget said that the government was going to continue to consolidate local government pension funds, which is, again, really good to see. The UK is quite rare in having hundreds, if not thousands, of very subscale pension funds, particularly government ones, local government ones. So they're going to be consolidating those and giving them the scale to be able to invest into venture capital, which is great. And then there was just a brief mention of that the government would continue to work on unlocking pension funds, would bring forward further measures in the autumn, along with also further measures to improve the functioning of the London Stock Exchange, making the UK a better listing location for science and technology business as well. So all very much aligned with the government's scale-up agenda and the BIA's scale-up agenda as well. Steve, I mean, that
yeah. So I think if you think about this is work that the BIA was heavily engaged in last year about how do we unlock new forms of capital as the NASDAQ is shut into both VC and ultimately UK firms. And you can see there's quite a lot of work going on behind the scenes, probably not going to lead to immediate money into companies in the way that the R&D tax credit will, but you can see that there is substantial reform going on behind the scenes, which we hope will unlock serious new taps of revenue. And there's some practical things here. British patient capital being essentially evergreen is really, really, really important because they are a core player in many of the bigger VCs that are investing in the UK scene, and we're really pleased to see that vote of confidence in them and through them into some of the VCs that then invest in UK life sciences. So I think this is really helpful long-term stuff, and it's great that it's continuing.
Yeah, absolutely. So we have we're almost at the end of our time, but we do have some more time for Q&A. So please do keep it rolling in. To my panelists, I mean, do pick out questions that you can see in the Q&A, but there's one from Neil here about the lifetime limit of 1 million for EMI and entrepreneurs relief, now called business disposal, asset disposal. Is that still the case? Is there still a £1 million lifetime limit for EMI?
And no change there.
No change. Yeah.
I'll pick an easier one. So because we've got some quite very detailed questions coming in. A good question about HMRC processing time on R&D tax credits. I think there's a lot going on in the revenue with R&D tax credits. You know, during the pandemic, they just stopped all inquiry activity. You could put in a claim for any old rubbish, and they paid out. That was it. And believe me, some of those claims were rubbish. So what they're now doing is swinging completely the other way. They've restocked those teams, a lot of activity. They're trying to work out whether they've got agents out there who are advising on stuff they shouldn't be, issuing letters to companies going, we know you made a claim, you're in an industry that we wouldn't normally expect to be making claims. So not biotech. So I don't know what else they're looking at, restaurants or who knows what. You know, are you really sure you meant to make this claim? Were you talked into it by a devious advisor? And there are a lot more inquiry activity in general. So I think while it's frustrating that you'll find some delays while stuff is subject to more security checks from the revenue, more inquiry activity, if you get inquiries, grit your teeth, get through them, because ultimately where hopefully we get to is more of those spurious claims will get found out. The lowering of the rate should in some ways make sort of claims less valuable for devious advisors to make. So overall, you end up with the right kind of companies, as in biotech companies making claims. The pot is then used in the right way, and we all benefit. That doesn't take away from the frustration if you do get inquiries from the revenue when you know there's nothing wrong with your claim and you thought you laid everything out clearly, but there is a lot going on and a lot coming down the pipe from the revenue in terms of requiring companies to give more information in the first place about the nature of your industry, the nature of what's in your claim, the nature of why you think you're doing R&D. Fundamentally, it is free money. It's non-dilutive cash funding for your business. You don't get something for nothing in this world. You've got to grit your teeth and go through it. And hopefully, by the time the revenue have tightened up some of their procedures, we'll all benefit longer term.
Yeah, if I can just comment, I mean, think about it as a societal position. What this is a co-investment from the UK public into life science businesses in an endeavour to get the UK economy to go, grow some jobs and deliver some outcomes. So I think as long as we think about this properly, and it's absolutely right, they are de-risking you and supporting you in the endeavours that you are doing, but that's really the societal purpose, and that's the social contract that we've got to continue to fulfil because that is that they could choose to spend this money on many other things. We are our responsibility with this cash, if you like, is to grow the UK economy, grow it fast, take some risks, and get some stuff to happen. And as long as we do that properly, I think that's the right approach. One of the reasons why we're going through these hoops is because many people have seen this as they've been encouraged into it by no win no fee merchants, and that's really not appropriate for this type of scheme. So as long as we're conscious that that's the purpose, and at the end of the day we have to justify it in front of Parliament and in front of voters as well, that's how we should approach it. And I think BIA member companies are absolutely the type of companies that are doing R&D for societal benefit, and we should be very proud of what we do. But the reason we're jumping through more hurdles and the rates are changing is because lots of other people were coming in alongside.
Yeah, and I must say we're very grateful for all the BIA members that went out yesterday, spoke to journalists, went on the local radio stations, BBC News, and explained what their companies are trying to achieve with these tax reliefs, and demonstrating the great work that they're doing and showing value to taxpayers. So yeah, thank you. Please do keep on telling that positive story to anyone who will listen. Sorry, Colin, did you want to come in there? Well,
I was only going to say, Steve, I've never heard anyone use the phrase social contract in a tax presentation before, but I quite like it. So yeah, thank you for bringing that one in.
Martin, I could probably pick off three of the questions very quickly for everyone's benefit, just in probably less than 90 seconds. So, Joe, you had a question on the RDEC rate. The RDEC rate stays at 20%, so that's unaffected by this. But I'll just repeat that your R&D, if you claim both SME and RDEC, the RDEC qualifying expenditure is good R&D for the purpose of the intensity fraction. Another question around full expensing, does that have any implications? Theoretically, yes, because with full expensing, in theory, you're going to have more losses. More losses will make you more likely to be a loss-making company, which will get you into the R&D intensity ambit. The reality is that most companies on this call will probably have already been within the 1 million AIA threshold anyway, so they may not have a fundamental difference. And then perhaps the most tricky question was from Aidan around capitalized R&D. I think the theme of the question is, can you sort of not manipulate, but influence your accounting for a better advantage? That is the one area that actually was covered in the technical note. If you do capitalize R&D, there's already a facility to allow you to treat that as expenditure in the year to allow you to claim the R&D credit. Now, I think most companies will still want to do that. And what the technical note suggests is that the way the intensity fraction will work will be such that actually it won't be distorted by you doing that. So it will take that into account, and you should get to a sensible outcome one way or the other. So I don't think there'll be any basis for manipulation.
Great, thank you very much, Richard. So I hope you found this webinar useful. Please do come and join us at any of these other BIA events that we have. You can go onto the BIA website and click on the events tab and sign up for those. If you're not a BIA member yet and you see what a great work being part of a trade association, what it achieves, and you want to be part of our community, please do join up. Again, you can contact us via the website for that. And yeah, thank you for joining us. I see we're at 5 o'clock, so I will sign off. Thank our panel. Thank you very much for joining us, Colin, Richard, Mel, Steve. It's been a great day yesterday and a great webinar today. Thank you very much. Have a good evening.
Thanks, Phil. Have a good evening. Bye.
Bye.